we do with oil, what does it do to the stock market?
Crude, 92. That's the number that matters right now, Tom.
Yeah.
89 on WTI. On Brent crude, 92.53. Headline inflation's going to be elevated because of gas prices. I think we all know that. It's baked into what we're estimating, actually. Headlines come in at 0.6% month on month. It's core. Where does core land? 0.2 is the expectation, which is why, in the minds of so many, Tom, rate hikes are on ice at the Federal Reserve next week. But there is this risk. This risk is still out there that maybe inflation starts to pick up again. And that's why this Federal Reserve needs to be somewhat cautious, TK, about how things materialize into year-end and beyond.
It's out there. There's a toxic brew out there 28 minutes away. But, Lisa, the real question is, what do we do at 8:31? How do we readjust to what do we got? Line up the ducks, a UAW strike, Formula One in Singapore. Then we move on to a Fed meeting. We're going to London on a reduced fare. Did you see that?
I did see that.
Yeah.
Did you get a reduced fare?
I got a reduced fare. They said,
I booked my ticket months ago.
Red Keeper of the Amex said, Tom, you're not taking the Gulfstream. Move on. And so there we are. Lisa, what do you think of this? I mean, at 8:31, we recalibrate.
It's actually a really good question, which is what is going to move the needle, given the fact that everyone is looking at core, expecting it to be sort of in line and not really showing any reacceleration. Headline numbers, people are expecting to go up, and they don't really care. They're saying, it's transitory, the Fed's going to look past it. When does that headline figure really matter in a more meaningful way? Can the Fed be cutting rates next year if the headline figure is still running really north of 3%, north of 4%, even on the heels of oil prices?
Torsten Slock channeling Jason Furman up at Harvard. I've been talking this up, John, whether it's 3-month moving average or 3-month annualized. Slock publishes today the trend, the vector in non-farm payrolls, 700,000. He's out about the time of the Arsenal-Tottenham derby that we see next year. 20,000 positive. David Kelly at JP Morgan says a negative NFP. That begins to fall into the debate after 26 minutes away.
Thanks for the promo, because Torsten Slock's joining us, I think, in about 57 minutes' time on the Open on Bloomberg TV. So we'll have this conversation.
Well-timed.
He put out some great charts over the weekend.
Wear a Jets jacket?
I've talked about that over a couple of days. That's my habit on Friday. He'll wear a Jets jacket.
Okay, excuse me.
He's put out some great charts over the weekend, TK, about why he thinks maybe we are sufficiently restrictive away from the mortgage market, what you're seeing elsewhere. Delinquencies up, bank lending starting to contract in various places, and that'll be a part of the conversation we have with him a little bit later.
Speed data check, 10-year real yield, 1.96%.
How fast? Just super quick. Equity futures down.
We got a great guess.
By 0.03%, yields up 2 basis points. Tom, your yield 430.
25 minutes, 37 seconds away. Daryl Cronk, Chief Investment Officer of Wells Fargo, joins us now with decades of experiment. Everybody's in a lather. Do I buy stocks? Do I add to my portfolio now? Do I go to cash? What's the mood at the margin with equity allocation?
At the margin, people are basically renting the market right now with a VIX that's at 14. You can use the options market with cheap premiums to get your exposure, but they're quick to sit near the exits. It's like your airline ticket to Europe. You want to buy the best seat and sit near the exit, right? And be ready to basically get out. So I think it's, we're stuck between this 4,300 and 4,600. All we've done is bounce back and forth between it. At this point, you need something to change in the baseline to really accelerate beyond the 4,600. Equity risk premiums are at a 19-year low. I'm not getting paid to take equity risk today.
Can we build on that just a little bit? Because I was curious too. I was looking back to the last inflation report. I think it was August 10th. Since then, the market's just been dead flat.
That's right.
And we've got the data we wanted to see, didn't we? With further signs of disinflation, growth still robust. What aren't we happy with?
So let's talk about inflation for a minute, right? When nobody's talking about this morning, everybody talks about the headline number, obviously going up because of energy prices. Everybody talks about core coming down, right? Which is important. Double click on core, right? Double click on core. What is Powell's super core doing ex shelter? It's going to go up 0.4 this month from up 0.2 last month, right? And it's still going to be running north of a 4% number and maybe even a 5% number. So if you think about, if you bookend this with headline, super core with core in the middle. Yes, core in the middle is a good story. Headline's not a terribly good story with the oil prices where they are. Supercore is not a good story.
So what are we talking about here? What industries are sort of reaccelerating in a way that's catching the Fed's attention? Because I'm getting lost in the core, supercore, non-core, how core. At a certain point, what is the Fed really keying in on if you are seeing housing costs disinflating on the margins? And, you know, people are seeing goods prices disinflate at a pretty hefty pace.
Yeah, it's a good question, Lisa. So I would say, obviously, if you think about inflation, it's commodity prices, it's wages, and it's housing. Out of those three, housing is giving us some good data, right, in the form of slowing, right? You're seeing mortgage apps go down. You're seeing existing home sales come crashing down, actually. Rents are coming down, so that's good. Commodity prices and wages are still very, very sticky. So if you get into that supercore, why is it up 0.4 to your point? Travel, the travel is starting to fade now, basically, and health insurance numbers are fading. So the services piece, which is what Powell cares about, is still running much hotter than people expect and want. So I think you've got to really look into the data much deeper than what a lot of people are doing. They want to take the core and run with it. It's a little bit like, I'm going to use a John analogy here, right? It's Goldilocks and the Three Bears, right? It's the English fairy tale, right? Everybody wants Goldilocks to the equity markets, but your three bears are oil prices, interest rates sitting a few basis points off a cycle high, and earnings, right, which we're coming to the end of third quarter. Earnings growth is still going to be basically zero for third quarter, which is still going to be a challenge. So who's going to win that battle, Goldilocks or the Three Bears?
Given the fact that basically you're saying oil prices matter, and they're going to matter to the Fed, and they're going to matter to input prices for services that really count on oil. So what are you expecting? How high does the headline figure have to be to capture the market's attention, to mean that the Fed has to respond to a headline figure that a lot of people say is very volatile?
I think the upside is calibrated well there. I don't think a headline number can get them off center for September. It may put November back into the conversation, right? But I think if you saw 0.8, 0.9 on the headline number, right, which would take your headline basically from, it'd put it somewhere around 4.7, 4.8, pushing a 5 number again. That would certainly get their attention, but they'd be able to, again, calibrate it to energy prices, you know, and food prices have moderated some, right? But, you know, I don't think the headline moves it for them. I really think the story is about core and supercore, ex-shelter.
Do you think they're still willing to beat down growth to get inflation lower?
Yes, absolutely.
I didn't get that impression in Jackson Hole whatsoever from the people around that meeting.
Well, look at, so in June, 12 of the 18 members who have a vote on a dot, right, an SEP, right, still say there are more hikes ahead of them. That didn't change in July, right? We'll see if it changes here in September. So they're still saying, like, look, we've got at least one more hike. Now, again, the market's taken solace from that of, like, that's the end of the road, right? It's kind of like one more for the road, right? One more hike and then we're done. And so they're taking solace in that, but it's what everybody talks about. It's keeping rates high for long and the grind that happens on growth.
I want you to talk to retail institutional Wells Fargo clients who have hit a home run with these 7 big tech stocks. They're all trading at 30 times multiple. So if I take a 30 times forward multiple Microsoft, how does that react given a presumed growth scarcity? Do they become ever more treasured and even sustain or trade higher in PE?
Well, that's been obviously the trade this year, which is when growth is scarce, right? You take whatever growth you can get, right? Which is the place you've been getting growth. I think what's interesting is if you break down things like the semiconductor industry, which is the darling, right? You've got now half of that industry in the S&P 500 below its 200-day moving average, right? It's failing technically right now. Consumer discretionary, half the names in the S&P 500 below their 200-day moving average, right? So under the surface, again, you're starting to see erosion and deterioration.
Are you seeing that in Apple, Microsoft, and the others?
Yes. They're all sitting, I mean, on a technical basis, the 20-day pierced the 50-day from above, which is a bad technical sign, and you're starting to see them fall down below the 50-day, which there's a big blue sky between the 50 and the 200-day, right? So what I would say there, Tom, is you're losing engines, right? If those were the engines for the first half of the year, right, think almost in terms of a plane, you're losing those engines that you need to really drive us forward here. And I agree with the conversation that you had yesterday about the consumer is stretched here, right? We have to pay attention to that.
Can we put some numbers on this just quickly? What kind of downside are you thinking about?
So we think the risk reward for equities, right, if you just use the S&P as a proxy, starts to turn around 4,200 or less. So it's probably, I'd much rather see it around 4,000, 4,100 to get equity risk premiums where they are, get multiples where they are. I mean, today, if you just simply take a 20 multiple,
Well, you sounded
John,
super gloomy, so it's not that drastic. It's 300 points.
No, I don't think it's a correction, right? And I think you use that correction to base off of for next year. But at 20 times earnings, right, you not only need earnings growth, the market's starting to demand it, right? It has to have it, right, in the back half of this year and early next year. So we've got to turn that at some point.
Daryl, this was thoughtful. It's good to see you. Always
You too,
is.
John.
Daryl Cronk of Wells Fargo. If you are just joining the program, welcome. We're counting you down to CPI in America. Equity futures right now on the S&P, totally unchanged almost. We're positive by 0.01%. Coming up shortly, Tom Porcelli of PGIM Fixed Income to weigh in on that inflation data. Mike McKee's going to be with us around the table as well, as is Regina Mayer of KPMG, because on CPI Wednesday, TK, we have got to talk about the price of a barrel of oil, WTI and Brent, at new highs for 2023.
Regina Mayer brings a great scholarship to this, and next week in London, I believe we're scheduled to meet with Christian Malik, who's just brilliant on EM demand and such. And I made as a joke earlier the stew that's out there, but you look at the airline shortfall, what it's done to that sector, if you will, back to pandemic, literally back to pandemic lows. And the basic idea I would have is, are we going to get clarity here in 17 minutes, 15 seconds? And I'm going to say, yes, we are going to have a clearer picture here at 8:31.
On what do you think specifically?
The vectors, the 3-month. I'm going to 3-month annualized. I was trained to take 90 days of data and squeeze it out 1 year as a respectful guesstimate, and that's a raging debate among the nerds right now.
Where's the clock now, Lisa? 16 minutes and 51 seconds, something like that?
Yeah, I actually agree. I think that we will get a lot of clarity, but not because of the actual numbers, but because of how the market responds. I think it'll be interesting to see where the balance of risks are right now, not for the Fed, for the markets, in terms of upside or downside potential surprise.
The 2-year yield came in a 5.04. I don't think that's a small matter.
I don't disagree. It's near cycle highs.
Yeah.
Going into an inflation print that is set to show further signs of disinflation on core. That inflation report is about 16 minutes away, live from New York City, with your equity market totally unchanged on the S&P 500. This is Bloomberg.
Connections. For over 200 years, they've been Citi's business. From connecting oceans and continents by helping finance the Panama Canal, to today, where we're still making our most important connections, people. We connect security and innovation, all to help drive growth. Our global scale connects businesses to over 160 markets, and today's ideas with tomorrow's opportunities. For the love of moving businesses forward, for the love of progress, Citi. With tomorrow's opportunities. For the love of moving businesses forward, for the love of progress, Citi.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer today on Bloomberg.
Slight slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's noise versus.
Will the ECB hike or pause this week?
There's a lot in flux at the moment.
ECB, they're stepping harder and harder on the brakes.
You have to be cautious.
It's much too early to think about a pause.
Inflation expectations remain anchored at 2%.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Is there a real danger of over-tightening at this point?
Stopping too early is a bigger problem.
Coverage begins Thursday on Bloomberg. Context changes everything.
It's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think is going to turn out to be pretty difficult. And so I think that means that when the Fed's going to keep rates higher for longer than people think.
Bill Dudley just nailed this Fed rate call a couple of years ago, the Bloomberg opinion columnist and former New York Fed president. I remember the conference. I was speaking to him, Mohamed Alair, and it was the summer of 2021. And Bill was talking about Fed funds going through 5%.
Yeah.
And at the time, Tom, I think we're all just shaking our head. What's Bill Dudley talking about? 5%. And here we are staring down a prospect of getting closer to 6. Never mind going through 5.
How did he do this? It was Dudley and McKelvey at Goldman Sachs. They had a young Turk, I think he was 23 years old, named Hatzius, who, picked up the coffee and be sure everybody was
doing all right at Goldman now, yeah.
And in the crucible of market economics, he would crank this out. He is a lone duck in our monetary policy. He's been in that and the crucible, again, is the right word. He's been in the market economics of day to day. Very rare.
And he's now talking about higher for maybe even longer. Let's go through the price action together, just going into this inflation report about 13 minutes away. Equities are totally unchanged on the S&P 500. In the bond market, yields are a little bit higher by 3 basis points at 431. The dollar's stronger against a weaker euro at 107.31 into the ECB tomorrow. But here's the number I want to talk about. 89.20 on WTI. On Brent, 92.46. And for the airlines, it's getting tougher and tougher. Unit labor costs are up, fuel costs are up, and the outlook is not looking good. We get a cut to the outlook from American Airlines this morning, Spirit as well. Lease American down 3.26%, Spirit off by 4%.
You could see the declines in commensurate airlines across the board. What's interesting to me is it's not just Spirit, which is more domestically focused. It's also American. This is a broad-based weakening when it comes to profits and the compression that you're seeing with costs going up, which raises a question, and we were talking about it earlier.
Oh, we're on the same page, Bramo.
Very
totally.
much. Is it just an airline story, or is this a broader economic story of what's to come in corporate America?
Can they pass it on?
Yeah.
Can they pass it on? So let's take crude. I'll go back to that framing we used in the last couple of hours. Is oil an example, a reflection of the extension of this cycle? Things are better than we thought they were, and we can absorb prices like that? Or a recipe to end this cycle? I'm not just going to talk about crude. Lisa, let's throw in yields as well. A high yield's a reflection of the extension of the cycle or a recipe to end it.
6 months ago, everyone said a recipe to end it. And then they were wrong.
Here we are.
And the economy just kept grinding along. Yes, we can exist at 5% benchmark rates. So if that's the case, are we misunderstanding some of the oil prices that everyone is saying is purely from supply cuts by Saudi Arabia? Is it also a demand side that could keep it going for longer than many people would like?
Can this economy get by with $92 Brent and 5% interest rates? We'll see. Inflation data just around the corner. Allow me to share the estimates with you. Month on month for headline, 0.6%. The previous month, 0.2, 0.6 is the estimate in our survey. Month on month for core, better reading. 0.2% previously, 0.2% in our survey. Mike McKee, you've got to break this one down for us in about 10 minutes' time. Mike, what are you looking for?
Well, we're looking at some of the categories that you just have been talking about. You and Lisa, airline fares have been down for 4 months in a row. They dropped 8.1% last month. Now, can that continue? that's something to keep an eye on. Maybe in August it did, but going forward with fuel prices up and now they got to pay these huge wage settlements, airfares could be going up again, and that's a fairly heavily weighted category in the core. We're also looking at shelter costs. Do we still see progress on rents and owner's equivalent rent coming down? And of course, everybody's favorite, used cars. Here's a tipping point. Is it going to change because the UAW goes on strike? The big three have very large inventories right now, so it won't matter for a while. But if it were a long strike, then you'd probably see used car prices go up again.
Mike, just to build on the oil conversation and this question of headline CPI versus core, at what point, based on your knowledge of the Fed and its history, what point does the Fed feel compelled to raise rates in the face of higher oil prices?
They probably don't, in that sense that they wouldn't directly attribute it to higher oil prices, because the Fed can raise rates all at once and it won't push oil prices down. What they'd be watching is consumer expectations. Do inflation expectations start to rise because people are paying more for gasoline? And that would have an impact on them. But exactly how do you attack that is difficult when it comes to oil.
Mike, 8 minutes away here. First thing I did when I walked in the door this morning is went to my favorite Cleveland 16% number. Great series out of the Cleveland Fed. Which series away from this gives you a better core knowledge than core?
Better core knowledge than core. I mean, the Cleveland Fed is good. You can also look at the Dallas Fed, has a trimmed mean as well, and a lot of Fed officials like the Dallas numbers. And also, what's kind of interesting is it only gives us a sort of look backwards, but the consensus forecast of economists surveyed by Bloomberg is one of the most accurate of anything that we survey on. So if we come in at 02 today and we come in at 06 on the headline, that'll just show you pay attention to the people who have Bloombergs.
Mike McKee will continue with us here 7 minutes away from this important report. We're going to digress here. As John mentioned, what else matters? $92.45 Brent crude. Regina Mayer is Global Head of Clients Markets and Petroleum at KPMG with military service to the nation. Regina, thank you so much for joining us today. Your research note is demand, demand, demand. Are the Saudis aware of the resiliency and demand that KPMG projects?
Absolutely. So part of the supply challenge is it's against the backdrop of a stubbornly robust economy, but it is also a big supply part of the equation, right? We are anticipating supply drawdowns through the rest of the calendar year, Q3, Q4, and we're in probably the tightest supply situation that we've been in 10 years, 10-month crude highs that you've emphasized. But what I'm looking at are some underlying indicators. U.S. production is almost at its record high, 12.84 million barrels per day against a record high of 13 million barrels per day, with 17% of the rigs off the market. That's 127 fewer rigs, with the Saudis intentionally keeping barrels off the market. Right now, we're saying there's roughly a 3 million barrel per day supply versus demand gap because demand continues to go up. And we think OPEC's purposely keeping about 1.8 million barrels per day off the market. And there's no global relief valve in this environment. We can't rely on the SPR. There's no other source where we can turn on a tap and oil will flood back into the market.
Given the fact that production is so high in the United States, is that an indication that, yes, inventories are the tightest, as you said, going back 10 years, but this isn't as much about supply as it is ongoing continued demand, and that people are underestimating the strength on the other side that's also fueling some of these price increases?
Yeah, so we've been talking about peak demand. Potentially it happened pre-COVID. I think we definitely have put that in the rearview mirror. Right now, the EIA is saying average demand for 2023 is going to be over 101 million barrels per day. That's average. So last month, we just came off one of the hottest summers in a lot of years, and we're anticipating that's 103 million barrels per day. That's the 3 million barrel per day gap. And then the EIA is projecting it goes up to 102 million barrels per day in 2024. When is peak demand going to take place? Some are predicting it's this decade, some are predicting it's next decade. Regardless of which decade you anticipate that it's coming, we know it's coming. So if you're a major oil company or a major resource holder, you're trying to figure out when's the last marginal dollar of additional investment that I'm going to put in to grow supply. against a backdrop of ultimately that supply is going to be in excess of demand.
Given that backdrop, if there is a recession or some sort of downturn, a softening in the economy, could that offset the tightness in the oil market? In other words, could oil prices come down sharply in a surprise, even with all of these technical backdrops, simply because you do get a weakening of the consumer?
Absolutely. I think if we start to see more signs that the economy is slowing,
you do get a weakening of the consumer.
We should be more sustainable.
Absolutely.
Amazon Business can steer us toward more sustainable products.
How did you know?
Doug's hat. We should be more sustainable. Amazon Business can steer us toward more sustainable.
This is easy.
How did you know? Sustainability. I feel good. What's next?
It's a car that runs on positive vibes.
I love people. Sustainability. Good vibes.
Amazon Business, partnering with enterprise leaders for smart business buying.
I think we have different aspects of energy policies. I think some of the things that we've just recently seen on Anwar is more politics versus substance. It would have taken billions of dollars in investment to get drilling production and then moving that material to market. We would be best served to focus on where are great sources of resources, Gulf of Mexico, onshore and conventionals, other dry gas plays. There are lots of different factors that slow down the ability for our industry to exploit those resources. I do think there's room for a more coherent, more effective energy policy overall.
The policy is lower prices, TK. I think that's the policy. We just want lower prices. That's kind of it.
That's dead on.
Regina, just quickly, when does demand destruction start to kick in? Aren't we already thinking about that in the 90s? That's kind of it.
For sure. I mean, I think if gas prices go substantially over $4, we're at the end of summer driving season, and U.S. gas prices are 12 cents per gallon on average higher than they were this time last year. It's probably not enough to drive demand destruction, but some of the things that you are all talking about relative to airfares, the pinch that people are starting to feel relative to how confident they feel about the future, how confident they feel about their savings cushions. I do see some of those pressures that could dampen demand as we move into the fall and winter.
Regina Mayer of KPMG on the oil market. Regina, thank you. Crude, Brent through the 90s, WTI getting closer. The inflation report about 2 minutes away. Given what we're discussing here, what's more important, inflation in a couple of minutes or retail sales tomorrow? Drew Madison MetLife writing in, inflation trends is unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change Fed
Totally agree.
thinking. That number drops, Tom, tomorrow morning.
I have it right down in front of me. I brought it up just as Drew was probably right in that. The idea, I agree, retail sales dovetails in here with a GDP adjustment, given any shocks, and then that goes into where Torsten Slok is in your 9 o'clock hour, which is a non-farm payrolls coming down.
Elisa, that speaks to the question you've been asking all morning.
Yeah, well, this to me is, at what point is retail sales a reflection of whether higher inflation is essentially eating into discretionary spending? I mean, that's to me the issue right now that we're facing off with, and that's the real question. And retail sales is the kicker to the chaser, which is really what we're going to get today. And ultimately, we just don't know, because it might have been boosted. We saw that, some of the peripheral data, there was, Amazon Prime or whatever, and people are back to school. And when you strip out all those distortions, what do you get? It's always been stronger.
You said something earlier on this week that I think is really important, and I saw it in Citi Research as well, so they agree with you. When the data starts to contradict, we're at turning points. And Citi said the same thing, Bramo, and there's a lot of data out there at the moment that seems to be contradicting with each other. Claims are super low, and then you look beneath the surface of the jobs market, you start to see some cracks emerging.
I was speaking with a policymaker, and I was saying to them, is the data manipulated? Is it fake? Is it the idea?
Massaged.
Yeah, is it
Massaged is the word,
massaged? Is it this people aren't really responding to all of the surveys? Is it messy? Is it inaccurate? And they just looked at me and they said, this always happens at these moments.
Yep.
We just don't know which way it's going to turn. It is too facile to simply shrug it off as raw.
Inflation data 15 seconds away, going into it. Equity futures on the S&P just slightly lower on the S&P 500. Yields in the bond market on a 10-year up by a couple of basis points. On a 2-year, 5.03%. Yields higher there by a single basis point. With the economic data this morning, here's Mike McKee. Morning, Mike.
Well, I said that economists were pretty good at forecasting, and they were pretty good at forecasting this time, except for the core there. It comes in a little hotter at 0.3 on the month, which pushes the year-over-year core to 4.3, still what had been forecast. The headline is up 0.6%, and that is what was forecast. And so the year-over-year number rises to 3.7% from 3.2. That's a tick higher, so it looks like perhaps that 0.3 was a revised up number. Let's take a look at some of the categories here. Food prices up only 0.2, so no real change there, but we get a big jump in energy prices. Gasoline up 10.5%. No surprise, I don't think to anybody, but it definitely has a weight on this index. Used cars and trucks fall again 1.2%. They're down 6.6% for the year, so that puts pressure on the other direction. And then, of course, services, less energy services up 0.4, but that includes a 0.3 gain in shelter. So let's see what the markets are doing. I'll get you some more numbers here in just a second.
I'll start with the bond market, Mike. Stay close. I'll come back to you in just a couple of seconds. So that small upside surprise on core inflation lights a fuse under the dollar. The dollar is a whole lot stronger off the back of this. Yields are a whole lot higher in the bond market, up 5 basis points on a 2-year. 5.07%, call it 5.08 on a 10-year yield higher by 6 basis points. So the whole curve a lift here. Yields pushing higher right across the curve. 2s out to 30s. Got a 10-year high by 6 basis points at 4.34. 30 are up by 4 basis points to 4.39. But it's that 2-year piece of the curve that gets your attention. So yields up, dollar stronger, euro dollar holding on to 107 again at 107.18, and equities just a little bit softer here. We're lower by about 0.25% on the S&P 500. Mike, you've had time to take a second look. What stands out for you now?
Well, we were talking about airfares before the numbers came out, and airfares did rise 4.9% during the month, so that is important. Now, breaking down the housing numbers, we see shelter, as I mentioned, had been up 0.3%. Owner's equivalent rent up 0.4%, but rent of primary residence up 0.5. That's a rise from the prior month of a 0.4 gain. So it does suggest that there is an issue with housing still not coming down the way that the Fed would like to see it. Overall, this is probably neutral for the Fed, and we can talk about the idea that perhaps we see retail sales have more of an impact, but hard to say at this point that anything will derail them from September hold.
I've got a derail, Mike. I got yen out to near 148. That gets my attention. It's a global distraction, but I've got a 10-year real yield out 3 basis points, popping to 1.96 right now. We even saw 1.98 seconds ago. Does an elevated real yield figure into Fed calculus?
It does over a longer period of time. As inflation comes down, obviously, real yields are going to rise. So the Fed has to keep an eye on that. They don't want to get any tighter than they feel they must be. But that's a long way away, and inflation on a headline basis for the CPI went up. Remember, the PCE is the Fed's indicator, and that has been moving at a slower pace than CPI. So the Fed is not overly concerned about where we are with real rates yet.
What I find interesting, Mike, just in the price action of the markets is that the long end is also affected in tandem with the short end. It's sort of this feeling that this robustness of the U.S. economy can continue even with rates where they are, even despite all of the negative discussions. From your vantage point, is it surprising? How surprising is it that we got some of these upside surprises in the core element, which was exactly where everyone was expecting to see the softness that everyone was hoping for?
Well, it is obviously a bit surprising. On a year-over-year basis, base effects mean that we don't lose any ground. We see the core year-over-year come down some. But the services prices, and we have to dig into that even further, the services prices are going to be a concern for the Fed. Now, one of the things that we had seen in the past is that commissions on Wall Street had gone into the CPI and the PCE and pushed up that services X housing number. And I haven't gotten that far into the data yet, but that's something to look for as well.
Mike, we'll come back to you a little bit later. Looking forward to catching up. Let's run through it. The fun and games lasted about 60 seconds. The whole move has faded since then. Equity futures basically back to where they were on the S&P 500, negative by 0.1%. In the bond bond market, we look a little something like this. Treasuries, 2-year, 10-year, 30-year, yields higher, but that move fades as well, up by 2 basis points on a 2-year to 5.04%. And if you take a look at the chart of the euro, if you can access one, basically back to where we started. We're negative 0.2%. Dollar's still stronger, 107.32. To discuss a little bit later in the next hour, Torsten Slock of Apollo, Caterina Simonetti of Morgan Stanley, Robert Tipp of PGIM TK, all of that in the next hour on Bloomberg TV.
So nothing burger, and what does it mean for retail sales tomorrow?
Basically
it's
that.
Simple.
That's it. 60 minutes of that,
Are you
Tom,
okay there?
on Bloomberg TV. That's the tease.
We're going to continue right now. And speaking of Mr. Tipp at PGIM, joining us right now is Thomas Purcelli, Chief U.S. Economist at PGIM. Fixed income, he's definitive with work on the open market desk at the Fed, and also truly great work on wage dynamics in America. Congratulations on a new shingle across the Hudson.
Thank you, sir.
As simple as I can, I want to go to your wheelhouse right away. You're talking to Greg Peters, which is really difficult. You've got to, prepare, medicate yourself.
He's the best. Love him to pieces.
You're talking to Greg Peters here, and he's going to turn to you just like I am and say, okay, but what about wage dynamics? That's what you own the high ground on. How are wages in America into 2024?
Yeah, look, I think here's the problem for the backdrop with regard to wages, which, look, in real terms, I think we'll appreciate are sort of performing decently. The challenge, though, is if you have real revenue that's moving sideways, right, which it is, and you have, which obviously is a function of the consumer that is sort of slowing down to some extent. How do companies respond to that? How do companies respond to real revenue moving sideways, wage pressures firming up a bit in real terms? I think that, to me, that's a perfect recipe for companies to go after labor, particularly if it means you're going to get a margin compression, which is something that we've been talking about for a while, and I think, Lisa, you and I talked about that last time I was on. That, to me, is a challenge as it relates to sort of the labor dynamic in the United States.
To translate this, they're going to be layoffs. That's basically what you're saying, is that if you see this incredible margin compression, if you see costs going up, and you see consumers pushing back on prices, the next step is people are going to lose their jobs. How much pushback is there actually to pricing if we're still seeing robust services side inflation, as this report just suggested?
Yeah, so, and what we know is that wage pressures, again, remaining firm in real terms, but it's coming in the context of inflationary pressure that's now slowing down. I mean, this 2/10 that we got, I get it, firmer than expectations, but that still doesn't change the trend. The trend of inflation is actually moving slower. So that means that the pass-through is becoming much more difficult for companies.
Well, but we're seeing this, we saw this with American Airlines and Spirit earlier this morning, so the pass-through is getting more difficult.
And sorry, no, I was just going to say, Lisa, I think it's such an important idea. Not only do you have that idea, this dynamic where the pass-through is becoming much more complicated, but just look at what some of the retailers have been talking about. I mean, the consumer is now trading down, right? I mean, just in the context of these wage pressure, these inflationary pressures that are out there, I think it's such an important idea.
The problem with it is, and this is what I'm struggling with, and I think a lot of other people are as well, we were saying this 6 months ago. We were saying that consumers were going to push back, and that savings were going to be beaten down, and suddenly, we were going to see, a recession. It didn't happen, and the data just keeps surprising to the upside, with this yet another surprise to the upside in core. How can you explain that?
Yeah, so I think there's a really easy way to explain it. So, in fact, there's a couple of ways to explain it. So one, the idea of excess saving is real, right? I mean, and the consumer is still working that down. So let's just be clear. The consumer has had a massive pool with which to sort of dive into. Excess saving was one of those ideas. The other was credit. I mean, credit usage has been, sort of off the charts. I mean, you're looking at revolving debt that's now running at $1 trillion. And so the consumer's been able to sort of perpetuate the sort of the consumer backdrop as a result of these two ideas. But just to be clear, that now is sort of drying up a little bit, right? Excess saving continues to fade. It's not gone. It continues to fade. Banks are now actually getting pretty stingy as it relates to how much credit they're willing to sort of lend out. And we can see that in, obviously, banks' willingness to make these kind of loans. And so I think the whole this backdrop is drying up, right? The ammunition is drying up for the consumer to some extent.
What I think is so important here is, and with Robert Tipp coming on in the next hour with John, you got to turn to a bunch of bond animals with the ambiguities between your economics and their portfolio management, can you assume a disinflationary tendency means price up, yield down in bond portfolios? Is that just a given?
Yeah, so I think this is a really important idea. One of the things that we've been talking about at PGIM is this idea that rates can stay high, rates can stay pretty elevated. And I think that you can have rates remain pretty elevated. I mean, when I think about sort of the Fed's reaction function to all of this, you know, and I get it. On CPI Day, we're talking about inflation. But the thing that I keep on coming back to, and I'm trying to bring it back to this today, here now, is the labor backdrop. Because I think when push comes to shove, I think the Fed's going to be very responsive to the labor backdrop. So I can easily make the case for the Fed to engage in an easing cycle. Now, I think when people say easing cycle, I think they immediately think of, hey, this big aggressive easing cycle. It's not going to be that. I think it's a dynamic where the Fed cuts back.
Their easiest path within asymmetry is to go longer. To stay elevated and go longer. I agree.
100%. And so to me, that's sort of the big challenge here for the Fed. I think it doesn't have to be a big aggressive easing cycle. It's not going to be a big aggressive slowing in economic activity.
Come in 25 or 50 beeps and just sit on it through 24.
I think that's exactly right. So our call has been, you can easily see a dynamic where the Fed cuts, you know, call it 50 to 75 basis points over the coming year. And I think that's how you sort of get to this dynamic where rates still remain pretty elevated.
Which is the reason why I wonder if Goldilocks and soft landing is the best case scenario for risk assets, or if it's actually the worst case scenario for risk assets over the longer term, particularly corporate credit, when you face off with this idea of refinancing. What's your view? Is that potentially problematic?
So it can be, right? I mean, I think the rollover risk idea will become a challenge, but that's not a challenge for necessarily right now, right? I mean, a lot of companies have done a great job of terming out their debt. One of the things that we've been talking about at PGIM and Dilip, my boss, I think he's been absolutely fantastic about highlighting this really important structural idea that's out there. I mean, which is something I've been talking about since, you know, my prior life. I think that the pieces are in place for productivity to really kill it. I think that's going to take time to develop. And I think that, Lisa, is basically, that's another really important idea to insert into your question.
We got to go. When you go across the Hudson River, does Peters let you use the Hinckley picnic boat he's got? Are you using the little Hinckley thing that takes you over to PG?
I'm just happy to be around him.
Okay. Tom Purcelli, thank you so much. Say Robert Tipp as well. He'll be here later. Mr. Purcelli is with PGIM. Fixed income markets, I'm going to call it flat. Standard & Poor's 500 down 0.1%.
Right now, I'm actually looking up Hinckley because I have no idea what that is. I've got to be honest. What is that?
Hinckley picnic boat is what Purcelli goes large on it. It's got side turbo thrusters, so you can just ease into the dock and Nantucket.
Okay, good to know. I'm looking this up. This is probably, it gives you a pro
When you
tip.
get done with the Grand Banks, you get the Hinckley picnic boat.
So if anyone is tuning in and trying to figure out what time is making up and what is not, or what he's projecting onto me.
Peters is gorgeous. He got the light blue,
all of these
the eggshell blue.
Boats, maybe you're projecting. Honestly, I'm just trying to put this all together and to understand the upside surprise in core, which was exactly what people didn't want. They thought we'd see an upside surprise in headline. I disagree, because it might be nothing burger right now, but put together with that 3-month rolling trend, just gives you this feeling that people are overestimating the downside surprises. Maybe. This is what I'm kind of taking away from it.
I'm with Purcelli on this. I think the jobs day all of a sudden became more important here. Get out the calendar. We're, first week on this.
How can we deliver one of the fuels of the future? Hydrogen could play a pivotal role in tomorrow's energy mix, but it's very expensive to transport. To ship it cost-effectively, we transformed blue hydrogen into blue ammonia. Discover how we delivered 40 tons of blue ammonia to Japan, catalyzing new pathways to cleaner fuels. Aramco, powered by How. Catalyzing new pathways to cleaner fuels. Aramco, powered
People's
by
hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world, to have metallurgy.
When somebody used my knife, I want them to say, damn! Golly, this is It's badass nice.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders. Right here on Bloomberg. On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders. Right here on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer, being the biggest part of the economy, is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months.
This is Larry Adam, earlier this morning, Chief Investment Officer at Raymond James, talking about what a soft landing means, because we always are looking for definitions as people cling onto these words that have very different meanings depending on who we're talking about. We've seen the moves fade, Tom. It was a pretty significant move in some of the Treasury yields, in particular in the dollar, and it's kind of just sort of shrugged off as people take a look and say, it's a month.
I'm going to go all David Rosenberg on you. Rosenberg used to write at Merrill Lynch with Mr. Farrell, and about page 3 or 4 of his report, which was read street-wide, this is before the internet, Lisa, where theft was in order, and on the right side, he would list all the components of inflation. And the phrase I use is Rosenberg slices and dices like no one. It takes time to go through the 85, 90, whatever it is, slices and dices. So we're going to have a different view of this inflation report. Not here. Do we do a count-up clock? Once we do countdown, do we count up afterwards? We're 17 minutes afterwards, and Rosenberg's, he's got a Labatt's port, and he's like trying to get through it by 12 noon.
Well, the data now continues, but in more granular form. And you say, what goes up? How do companies deal with this? We did see airline tickets actually tick up in this latest report. As we hear about some of the margin compression at a number of them, I want to take a look just quickly at American Airlines and Spirit, which came out earlier today, revising downward their earnings outlooks. We saw EPS downgrades at American. We saw revenue downgrades at Spirit. Those shares down both 3.6%, 3.7%. They've come off some of the lows. But to me, this really highlights this question, what do companies do? As we were just hearing from Tom Porcelli, what do companies do when their input costs are going up and their prices are not necessarily being received well by consumers?
I get criticized. It's been a theme for me for 18 months. Corporations are going to adjust. They're adjusting in rapid speed now. And what the airline thing today signals to me is just the continuum away from the pandemic. It's like we're in some new phase after we all traveled like idiots. I mean, we're all the same on this. We all took the 7 flights we didn't want to take. And all of a sudden now it's now what for the airlines? I'm fascinated by what they say. I know we're speaking with Hurley from JetBlue here coming up on Bloomberg. She is grizzled financially about what do you do in the room when you face $93 Brent.
It's a larger story, though, also because it's not just energy prices. We heard this from American. It's also labor. It is a pushback there. And these two polls are really creating a confusing toxic stew, which creates the situation of we don't know how companies are going to respond. Are they going to hoard labor, or are they going to take the Tom Porcelli route and start laying off some workers?
Well, the ambiguity of it's interesting, and it leads to the jobs report, and as a number of you said, emailing into me the retail sales report tomorrow. Joining us now with wonderful perspective is Rob Waldner, Chief Fixed Income Strategist, Head of Macro Research, owner of the High Ground at Invesco. We're thrilled that he could join us today. Rob, ambiguity in microeconomics is you really don't know which way the curve is going to go. In fixed income, I got lots of ambiguities, mysteries, uncertainties right now. What's the lead ambiguity for you and Invesco?
Well, I think if we're trying to look at the ambiguities, let's look at where the market action today. So, I mean, I think, we saw that CPI was slightly disappointing from a fixed income perspective, i.e. core came in a little bit higher month on month than we were expecting. It keeps the disinflationary trend in place. But nonetheless, it was a disappointing number. And I think, as you pointed out earlier, you can't really tell in the market. The market's behaving very well. So I think that tells you that the market is not fully bought into this disinflationary trend idea, and tells you that the market is more worried about inflation than maybe it needs to be.
In a given bond portfolio, and there's 472 of them at Invesco, flavors, I should say, of portfolios, the basic idea is you have to adjust. How do you adjust a bond portfolio now? Is it a duration dynamic? Is it a portfolio structure dynamic? What's the variable of action into the fourth quarter of this year?
Well, Tom, as bond managers, we really have two components to yield in our portfolios. One is the overall level of yields represented by the Treasury market, or real yields in the Treasury market, and the other is credit spread. And I think when we look at the balance now, going into the fourth quarter and going into 2024, we've been of the view that we would have a bumpy landing, but with a growing risk of a potentially slowdown in 2024, further slowdown. And so in that environment where we've seen real yields come higher, so the real yield component is higher, and the spread component has shrunk over the balance of this year, I think that favors putting more of your resources towards real yield. And we know that the market itself has been putting money into money market funds instead of into duration. We have, close to $1 trillion of money has flown into money market funds this year. So that tells us that the market is not valuing duration and real yield as much as it should be. And so we would be reallocating towards that sort of longer duration real yield into more traditional bond portfolios, and using that as the core building block of our portfolio structure.
Let's build on that, Rob, because you said that what we have seen today in terms of the market response to today's report was that the market hasn't bought into this disinflationary idea, has not bought into this disinflationary idea, and that they're maybe more worried about inflation than they ought to be. How much are you loading the boat right now? Are you basically just going out and buying every 10-year Treasury note that you could possibly find, saying, this is the time to lock it in because it's not going to last?
We do think we're at the top of close to the top of the near-term range, Lisa. So, I mean, load the boat. I'm not sure we're getting overweight from a bond perspective in high-quality credit. And we think that's a good buying opportunity.
When you say high-quality credit, I'm wondering how much we're also talking about corporate credit. At what point, when we talk about margin compression and this question of what do companies do with the fact that their costs are up and they cannot raise their prices commensurately, how much does that weaken corporate credit as opposed to improve it at a time when the revenues were increasing and they didn't have to refinance yet?
Well, so the fundamentals, I think you're driving here at the fundamentals behind the corporate sector. There's no doubt that I would put it slightly differently than you did, but I think I'm saying the same thing. No doubt that very high nominal GDP growth that we've had over the last couple of years has been very, very supportive for the corporate sector. And as that nominal GDP comes down, so nominal GDP growth now, in our estimation, is running somewhere trending around 4 to 5%. So we're now down below the level of interest rates. That is going to put pressure on the economy overall, and including the corporate sector. So fundamentals will be less positive going forward, but the offsetting benefit will be if you're in longer duration bonds, that you will get some benefit from that duration.
Rob, I did a wonderful panel last week with Christina Campany. We all didn't like her. She stole the show, which was unfortunate. But your Christina Campany made real clear, as you stated, that with a reduced nominal GDP, a reduced animal spirit, things change. What will CFOs of corporate America do?
The problem is people will get squeezed. CFOs will get squeezed if they don't have that pricing power that Lisa was alluding to. which is the same thing as saying nominal GDP comes down. I think CFOs are in a pretty good place in that they've, as far as we can tell, in terms of financing, there's not a lot of near-term financing needs. So it'll be more of I think, Tom, it'll be more of a sort of longer term, as things reset higher, squeeze rather than an immediate impact. But it is going to be more difficult to manage through an environment where your top line is not growing as fast as your funding costs are going up.
Rob Alder, thank you so much. With Invesco, Lisa, this is so important, and I'm going to go back to a huge mentor and someone of great influence on me, Philip Correa. We enjoyed living to 104. He was brilliant. He was inquisitive. He founded Pioneer Funds up in Boston. And Mr. Correa would say to me, the young whippersnapper on the elevator, he would say, Tom, don't forget the bright lights of inflation. And under the bright lights of inflation, it's easier for CFOs. Inflation helps people feel in the real time that things are great. It's getting a little dimmer out there right now, is how I'd put it.
It's a transition moment. And what we're transitioning to is the really big question that we just don't understand. But it's getting harder for the CFO to understand exactly how to navigate.
What timing? Matthew Miller, in conversation with the CFO, the financial timing. Matthew Miller.
Connections. For over 200 years, they've been Citi's business. From connecting oceans and continents by helping finance the Panama Canal, to today, where we're still making our most important connections, people. We connect security and innovation, all to help drive growth. Our global scale connects businesses to over 160 markets, and today's ideas with tomorrow's opportunities. For the love of moving businesses forward, for the love of progress, Citi. And today's ideas with tomorrow's opportunities. For the love of moving businesses forward, for the love of progress, Citi.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The smallest of upside surprises on the inflation report, and the drama in the market lasted about 20 seconds. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, US CPI coming in stronger than expected. United Auto Workers are heading towards strikes, and Citi on the cusp of another huge restructuring. We begin with the big issue, inflation in America.
We're focused on inflation.
The CPI print.
CPI is important. Continues to be a very important thing that we talk about.
Firmer than expectations, but that still doesn't change the trend.
At the end of the day, we've had a great deal of disinflation.
Trend of inflation is actually moving slower.
Where does inflation finally go?
Does inflation continue to soften into the end of the year, or do we get a rebound?
We're certainly going to get some good news on the inflation front in the back half of this year.
It's a question of how the Fed interprets that.
What does the Fed do with that?
I don't think the Fed's really going to change the trajectory in terms of September.
The question will become the November meeting.
They're either on pause or they got one more hike.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
This is a very complicated time for the Fed.
A challenging environment for the Fed.
This is not going to be the last of the inflation worries that the market's going to have to face.
Joining us now to discuss PGIM's Robert Tibb, Torsten Slok of Apollo Global Management. Torsten, first to you, your view on that inflation data from 31 minutes ago.
Absolutely. The trend is moving in the right direction. There is a number of nuances here, looking in particular at supercore inflation, which the Fed has been focusing on, still at 4%. We see still a number of areas where inflation is certainly coming down, but most importantly, in services, there's still a number of question marks. In particular, you have a number of areas where you still see inflation moving up. So the conclusion to your question, Jonathan, is that yes, this is so far so good, but all these numbers, which are 3-4%, are still above the Fed's 2% inflation target.
Vishy Tirupattur of Morgan Stanley on this program yesterday. His line, the Fed has done enough. Robert Tibb, has this Fed done enough?
I think they have. I think we're seeing that in the growth numbers. And today's number was not an easy number, you know, to tell that story with the high headline and you know, some of the areas like the airfares shooting up again. But when you get to the core of the number, if you look X, food, energy, shelter, you're looking at a pretty good 3 months where, you know, in total, you haven't seen a 1% annualized rate of inflation. That's something that was running at 4% in the prior 3 months. So I think there's going to remain some anxiety as to whether this drop in inflation is transitory, right? They're not going to feel really good about this until they see 6 months, 9 months of a good trend towards low core inflation. But I think this is good progress.
Robert, that's the risk, isn't it? Torsten, let's talk about it. They viewed the spike as transitory. They were wrong. Is the drop, the disinflation itself, transitory? Let's talk about it.
The key about that issue is that it's important to think about why is it, for example, supercore is still so elevated. Why is it not really coming down, in particular not on the PCE side? It's because the service sector is still doing quite well. People are still flying on airplanes, still eating at restaurants, still staying at hotels, still going to sporting events, concerts. That's why you see supercore inflation, meaning consumer services inflation, do quite well. So on a number of fronts, it is still for the Fed the case that they might still have to step a little bit harder on the brakes. I don't think we'll get more Fed hikes, but they still need to keep rates elevated to make sure that the service sector starts to slow down, because we haven't really seen that quite yet. And that's at the core of this discussion, namely, do we need to see goods only come down because the goods sector is back at pre-pandemic levels when it comes to inflation? But if we also need the service sector outside of housing to come down, then we do need restrictive monetary policy for quite an extended period ahead of us.
Well, Torsten, that's the question, isn't it? Are we sufficiently restrictive? You put out a deck. I've been talking about it the last couple of days over the weekend. Just fantastic charts. Charts after charts suggesting that we're starting to bite. Fed policy is starting to bite, maybe perhaps more slowly than we thought it would be, but it is biting. Are you convinced by that?
Absolutely. And the key issue here is it bites every single day. At the moment, every single day, there are companies who cannot get a new loan because interest rates are too high. There are companies who cannot roll over an existing loan. Likewise, on the consumer side, delinquency rates are going up on credit cards, delinquency rates are going up on auto loans every day because of the cost of capital being elevated, because the Fed has been hiking rates. There we are seeing both on the consumer side and on the firm side that it's beginning to bite, as you're saying, harder and harder. And if you think about it from a Fed perspective, this is the whole idea from the Fed. That's the reason why they're raising rates. They want us to spend less on our credit cards, to buy fewer cars, to hire fewer people in companies, to build fewer factories. So in some sense, this is exactly what the textbook would have predicted, that the economic data is exactly beginning to see the implications of Fed hikes beginning to show up.
Initially, off the back of this report, yields were higher. They're lower now. We're down by 2 basis points on a 2-year, still just above 5% on a 2-year maturity. The 10-year yield just about unchanged here at 4.29. With the data, let's get to Mike McKee for a little bit more. Mike, your view now, 35 minutes in. Are you seeing that sufficient progress Chairman Powell wants to see?
Sufficient progress, perhaps, to keep them on the sidelines in September. But there are things to watch in this report that would keep them on edge, perhaps, about November and or December. Let's start with the good news here. You see the core services ex-housing up 0.4%. That's the wrong one. I'm looking at the wrong one. Let me just call mine up here. This is core service. This is core. CPI core up 0.3%, 4.3%. That's the lowest since 2021. So on the core side, we are seeing progress, and that is good news because that's what the Fed's looking at, not these headline numbers that get distorted by gasoline. But speaking of getting distorted, we have some issues, and this is what I was talking about, where you're going to have to keep an eye on things. Rents and owner equivalent rent went up more than anticipated, and home prices are rising again. Is that going to continue? Used cars dropped, but what happens if the UAW goes on a large and lengthy strike? Airfares were up 4.9%, fuel and wages rising there, and gasoline, of course, everybody has seen that at the pump, 10.6%. Oil prices rising means gasoline prices continue to rise, and maybe that means that the Fed has a problem with inflation expectations. All right, now I want to go to the chart that I was talking about earlier, and this is the supercore one that everybody wants to see. We saw it rise more than anticipated, up 0.4% on the month and up 4.05%, so call it 4.1% on a year-over-year basis, driven largely by transportation. And that includes the airfares that rose significantly, and also car insurance up 2.4%. So while we do have a rather benign outlook in the core for this month, we'll have to see what happens in September and October as the Fed considers what to do in November. And since you liked this so much yesterday, John.
Loved it.
There is no Barbenheimer Taylor Swift effect. Hotels and motels were down 3.6%, and admissions to movies and concerts were down 0.1% in August. So they did not push inflation higher. You can't blame Taylor for that.
Michael McKee, thank you, sir. Appreciate the update. We should get Morgan Stanley back for an update on that too. Mike McKee there breaking down the economic data. Mike mentioned energy, 92 on Brent, WTI at 88. Robert Tipp, this from Marco Kalanovic at JP Morgan this week. The potential for the commodity price surge to feed inflation and extend central banks' hiking cycles. Robert, how do you look at this? Is this a reflection of the extension of the cycle or the recipe to end it?
Oil is really important, and I think that if this looked like a sign of demand, of accelerating activity, that would be problematic. I think it's more symptomatic of the supply side. I think that when you look at the demand side of the economy, we're seeing the sluggishness in China, certainly, sluggishness in Europe, and frankly in the U.S., these payroll numbers have been decelerating. The trend is pretty profound, and we're not talking about 1 or 2 months. We're talking about since the beginning of 2022, a very steady deceleration in the pace of job growth and a narrowing. So a lot of the job growth has been focused in healthcare, not in cyclical sectors. Those are coming, close to a trend pace, but you really need the line to bend here. You need the deceleration to stop in order to avoid a stagnation in the job market at this point. So I think you are getting a lot of cooperation on the inflation. Again, looking ex-food, energy, shelter, things have really calmed down. The jobs numbers have slowed, and the wages have really decelerated. So I think you're looking at a Fed on hold that is going to be looking for an opportunity to make that case that they have passively tightened and look for a window to cut rates. Our forecast is for next year, but frankly, it wouldn't surprise me if they were going to a pretty decent easing bias before the end of the year.
Well, Robert Tipp, with that in mind, BMO, Morgan Stanley, Wells Fargo, JP Morgan Asset Management on this program, they say buy the 10-year here. Robert, do you agree?
I think we are at the top end of the range. I think people are seeing a peak in the short-term rates. You can make the case that the value is not great, based on a 5.30 Fed funds rate. What do you want to be doing? Going out on the curve and giving up 100 basis points. But the real yields implied in this market, 2% real yields, those are seeing support. And I think that's what's keeping this curve inverted. Not really hardcore fear of a recession, but just the perception of value. So I think we're going to be looking at an inverted curve for some time. I think we are near the top end of the range in yields. That's the case we've been making for the last few quarters, that we've rewound to your 2002 type levels.
Yep.
Yield is destiny. Outlook for the market is very favorable.
Near cycle highs right now on a 2-year and a 10-year for that matter. 2-year around 5%, 10-year around 4.30. Gents, stick with me. Robert Tipp, Torsten Slog. Your equity market on the S&P 500 doing okay. Some big moves over at Citi. Shanali Basak has that story. Hey, Shanali.
Hey, John. We're looking at the biggest restructuring at Citigroup in about 2 decades, because not only are they restructuring their investment banking trading units, they are restructuring the entire bank and its top management layers into 5 main business units that will report directly to CEO Jane Fraser. Now, in the early reactions, you are seeing a lift up in Citigroup stock. I did also just recently, right now, obtain a memo that Jane Fraser, the CEO, had sent to her own staff saying, I know many of you share my frustration that we are seriously underestimated as a bank. No one else has our global lens nor breadth of our insights and on-the-ground capabilities. Now, what does that mean? While they try to capture share, they are eliminating regional leadership roles. That means across the world, you may see significant job cuts among management ranks. That is according to our own sources. In her own executive management team, 19 members have been named. Now, in the investment bank itself, where she is trying to stay competitive, gain share, she named Peter Babet, the head of Asia Pacific, as the head of that business. But listen, John, that person will be stepping down, and Citigroup will be conducting a search for a new head of banking that will include that investment bank where Tyler Dixon is leading all the team's deal makers, and Jason Ricate, who is overseeing corporate banking, which Citigroup considers to be sort of their quarterbacks, the people who are across the world building relationships with clients and bringing in business. So significant day over at Citigroup, very large restructuring. This is just the tip of the iceberg. We have understood that it would be at least until the fourth quarter when we get more targets, financial results associated with these businesses, and targets in terms of what those headcounts could look like and the costs associated with them.
Shanali, we've heard from a lot of management on Wall Street in the last couple of days. There's a big conference taking place this week for Wall Street banks. Are we going to hear from Jane Fraser a little bit later?
That's the expectation. Currently, Mark Mason has been on the menu for that discussion, CFO of Citigroup. But we are understanding that Jane Fraser will make a surprise appearance and give remarks surrounding the big restructuring we're seeing over at Citigroup. Now, I will maintain she won't give financial targets, unlikely to give until the fourth quarter. However, this is a significant restructuring on top of the initial set of changes she's made over at Citigroup, exiting businesses around the world.
Shanali, thank you. The stock is positive by 0.9%. Stay close. We'll talk about this again around the opening bell, I'm sure. Coming up on this program, on the labour market, United Auto Workers heading towards a strike.
Never been so contentious, and I think that is probably the scariest part of all of this, that the sides seem very far apart. It feels like, strike is likely. I think
that conversation up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It feels like, strike is likely. This fragile chain can suddenly break again. And I think that's really what the scare is, because we're not thinking about doing this during a time where inventory has been bloated for a long time. We're talking about a time in which literally we're still in a recovery mode. It's, further along in recovery, but recovery nonetheless.
A united auto workers strike looking more and more likely. Negotiations between the union and Detroit's Big Three remaining far apart. Ford CEO Jim Farley telling Fox News the automaker is preparing for the worst.
We don't want to see a strike, but we're prepared to strike if we have to. It'll have a tremendous impact on the economy and our suppliers, but we're still optimistic we can work together through this.
And according to our reporting, the UAW president planning to confirm the union strike plans at 10 p.m. Eastern tomorrow. That's 2 hours before the contract officially expires. Joining us from Washington, Bloomberg's Anne-Marie. AMH, what's the latest?
Well, Jonathan, the latest is that potentially we will see this strike. You can see it there, what Sean Fain is doing, preparing for that. We should know around 10 p.m. tomorrow whether or not he's going to pull the trigger and exactly which plans he is going to have these walkouts and strikes at. And at the same time, the Ford CEO said yesterday that they've come back with the best offer they've ever given the UAW in its history. But it still does not look like, Jonathan, that it is going to be enough. You see both of these party lines continue to harden. What we heard this morning from Sean Fain on Good Morning America, Jonathan, is that he says that, yes, of course, potentially we can get there, but we're just not there yet. We've got 48 hours. That's not a lot of time. But more interesting, Jonathan, he's pointing to the fear-mongering that he says is out there right now. And he says how people are saying this is going to start to wreck the economy. He says it's not going to wreck the economy. It's going to wreck the billionaire economy. He goes on to tell Good Morning America that's the big issue here, especially in this country. The working class is living paycheck to paycheck, feeding off the scraps. And Jonathan, that plays in today's inflation report. It's everyday Americans that are living paycheck to paycheck that feel like inflation is just eating away at their wages.
So on Thursday night, Anne-Marie, if that strike happens, are we getting a statement from this White House supporting it?
I'm not sure you're going to get a statement supporting it. What you will see is a statement likely what we saw a month ago, which was that they want to see fair and just wages for the UAW. At the same time, they want to make sure that these companies can be viable. They are really going to do their best to try to walk this down the middle. But it's going to be challenging, Jonathan, because time and time again, the president likes to boast that he's the most pro-union president in modern American history.
AMH, down in Washington, Anne-Marie, thank you. Torsten Slok, back with us with Robert Tibb. Torsten, I want to lean on a question I've asked before and give you an opportunity to answer it. Is this an example of the dying embers of a hot labour market, or is this a sign of more to come?
The issue is that since the Fed started raising rates in March of last year, we have gradually seen the labor market start to slow down. But it is still the case that the unemployment rate is at a very low level. We are seeing job openings coming down. We're seeing the quits rate, meaning how many people voluntarily quit their job every month, is also coming down. We're seeing the work week coming down. We're seeing wage growth for job switchers also coming down. So things are gradually softening, but we have not quite yet seen that increase in jobless claims or that increase in the unemployment rate that the Fed and the consensus had expected even just last year. So the answer to your question is that there's still relatively hot labor market, but a number of the leading indicators are pointing towards more softness, and that's what the Fed has been talking about for so long, and Jay Powell has been saying that they are interested in seeing a softening in the labor market. And with that backdrop, of course, I think that indicators are pointing towards that softening coming.
Can corporate America absorb any of this? We've been talking a long time about passing on higher costs to consumers. The price tolerance, has that basically faded away? This is what Ford had to say off the back of UAW in these negotiations. There is a line in the sand for the sustainability of the company. Robert tipped the airlines this morning, cutting the outlook off the back of higher fuel costs and in some places higher labor costs as well. Robert, do you think we can pass on those higher costs to the consumer, or are we at that point where they have to eat it and margins are going to get squeezed? Robert, do you think we can?
Yeah, it's not really a spiral, but I think you're going to have ongoing pressure with wages and inflation. It's not going to be a sudden stop, right? People have lost a lot of purchasing power with inflation outstripping wages. The labor market isn't as tight as it's been, but it's tight. So you're going to see labor working to catch up. A very small percentage of the labor force is unionized, but the rest of the labor force is going to see these settlements and is going to try to get their piece of the pie expanded relative to what they've lost from inflation. So I think this is going to take a while. But I think the Fed has been very flexible on wages, recognizing that there are a lot of moving parts and that having a higher rate of wage growth may not be inconsistent with their hitting the inflation target. And, you know, the rate of wage increases that we saw from 2011 to 2021 were quite muted. We'd seen rates of increase in the ECI that were much higher, you know, in the 3.5 area, that were quite consistent with price stability. So, you know, we're at 4.5 year over year right now. But, you know, we have seen some deceleration. I think that all of this is consistent with a slow winding down towards target here in terms of inflation.
And Torsten, final question. Retail sales tomorrow. This from Drew Madison, MetLife, in the last hour. He said inflation trends unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change Fed thinking. Torsten, what will you look for tomorrow morning?
Yeah, I mean, combining the things that we're talking about here, everyone talks about a soft landing, but they really mainly talk about a soft landing in the economic data, including in retail sales. But we need a soft landing not only in consumption, in capex spending, in GDP, we also need a soft landing in inflation, and we need that at the same time. And that's the thing that we should be debating in markets. Is it possible to get that everything comes down Goldilocks style, where we get inflation back to 2, consumption starts to move sideways, everything is fine? Or is there a risk that, yes, the economic data might continue to slow, but inflation is just the more sticky and at risk of staying higher? And if that's the case, the Fed will stay restrictive for longer, and that will put more downward pressure than on the economic data. So it's the combination of the dual mandate of the Fed here of trying to get both a soft landing on retail sales, on the GDP, on the economic data side, and also a soft landing in inflation at the same time. And that's what I still think is not the most likely scenario. We should still continue to worry about the downside risk being more meaningful.
We make it sound so easy, don't we, Torsten? It's not, as you just said. Torsten Slok, Robert Tipp, to the both of you, fantastic. As always, 7 minutes out from the opening bell, equity futures totally unchanged. Coming up in the morning calls and later, US inflation surprising slightly to the upside. Morgan Stanley's Caterina Simonetti joins us at the opening bell, making a case for high quality defensive areas of the market.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule. It is then the market forces and the business incentives of global companies.
From New York City,
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
9 a.m.
Stocks just about unchanged. Let's get you some morning calls. UBS upgrading forward to buy from Sal, saying the impact from a potential strike will be short-lived and transitory. JP Morgan downgrading Oracle to neutral, growing increasingly concerned about the company's cloud business. And finally, Wedbush raising its Apple price target at 240, expecting new iPhone sales to surprise to the upside next year. Coming up, a stronger than expected US inflation report. That conversation with Caterina Simonetti of Morgan Stanley.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries. And also to appreciate the cultural practices such as braiding that our ancestors for centuries.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
23 seconds away from the opening bell in New York this morning. Good morning to you all. Coming off the back of the first down day in 3 on the S&P, we are totally unchanged on equity futures on the S&P 500. Likewise on the Nasdaq, following the smallest of upside surprises on the inflation report in America. Here's your opening bell in New York City. Switch at the board and get to the bond market. Yields were higher, then they were lower, now they're higher again. 428.62 on a 10-year, still near 430 on a 2-year, still near 5% on a 2-year yield. The dollar just a touch stronger against the weaker euro. The euro in a world of pain. Let's sit there just for a moment. Stuck between a rock and a hard place. President Christine Lagarde. Germany set to revise its growth outlook lower for contraction for the rest of this year. And then on the other side of things, the ECB reportedly ready to upgrade its inflation outlook for next year to above 3%. What do you do with that? 107.47, Nomura looking for 105. In the commodity market, new highs for the year on crude, $89 a barrel on WTI. We're positive there by 0.2%. 40 seconds into the session, we're going absolutely nowhere on the S&P 500. Likewise on the Nasdaq. One stock to look at, it's Apple. Its launch event overshadowed by headlines out of China. The country's foreign ministry saying this: we've noticed there have been many media reports about security incidents concerning Apple phones. Ed Ludlow can explain this one. Morning, Ed.
Yeah, good morning, Jonathan. I would just point out Apple is modestly higher, 0.2% and rebounding from that 1.8% drop on the iPhone launch event day 24 hours ago. If you don't mind, I'm going to read the quote again because this is a nuanced story. During a briefing, Chinese Foreign Ministry spokesperson Mao Ning said the following: "We noticed that there have been many media reports about security incidents concerning Apple phones." What happens in these briefings in China, John, is that there is a real-time Chinese or Mandarin exchange and a simultaneous English transaction. And what we note in our Bloomberg report is that the English translation omitted the phrase media reports. The significance is this is the first time that China has publicly acknowledged the reporting by Bloomberg and others that China's central government has instructed government agencies and state-backed enterprises to inform staff not to use a foreign handset, including iPhones, and to switch to a domestic handset. What is really important with this story is that the spokesperson, Mao Ning, went on to say that China has not issued laws and regulations to ban the purchase of Apple or foreign brand phones. And actually, if you look across the media landscape this morning, many outlets leading on that there is not, according to this spokesperson, an outright ban. Shares up now 0.5 percentage point. Remember, we got exactly what we expected at that iPhone event yesterday when I was down in Cupertino. iPhone 15 Pro, $999. If there was any surprise, and this is what the sell side's jumping on, it's the slightly higher price point of the 15 Pro Max, $1,199 or $1,200. But with the starting model having 256 gigabytes of storage, they want to see them use the lever of the higher prices, knowing that driving unit volume growth is really hard for Apple right now. It was an all singing, all dancing, bells and whistles phone, John. It's exactly what Mark Gurman reported it would be, and it was a classic iPhone event down in Cupertino.
Ed, you and Gurman, great coverage in the last 24 hours. Thank you, buddy. Ed Ludlow there on Apple. Let's turn to the auto sector. The EU launching an investigation into Chinese subsidies for EVs to ward off cheaper imports. European Commission President Ursula von der Leyen saying this: their prices kept artificially low and it's distorting our market. Abby has more. Hey, Abby.
Hey, John. Yeah, pretty protectionist behavior here out of the EU toward China and the Chinese EV makers. They are launching an investigation into Chinese subsidies for EVs. And the reason really has to do with the growth of China EVs, sales of China EVs in Europe. In 2020, they had 1.1% of the market. Now in 2023, they have 5.6% of the market. So over just a couple of years, 4.5% growth. And of course, there are many German automakers, BMW, Volkswagen, Audi, Daimler, that have EV vehicles to sell, many of those starting above $100,000. So the EU really looking into whether or not these subsidies are helping China and those Chinese EV makers take share. It's not clear whether or not actual tariffs will come from this. Earlier, the German automakers had been higher. Now they're basically about flat on the fear. Will China retaliate Relative to the stocks, John, it's interesting because on the year, NIO up about 6% on the year, BMW up about 16%. So it seems as though the EU probably not thinking about share prices, but potentially this could protect investors of those automakers as well.
Oh, this is so important, Abby. Thanks for this. This connects to the story here in America as well. How do these names compete with rivals in China on a cost basis, particularly with this UAW dispute taking place as well? This line from Mr. Farley over at Ford, there is a line in the sand for the sustainability of the company. They're thinking about how they can compete with Chinese EVs as well. We're about 5 minutes into the session. We're just about positive by 0.2% on the S&P. On the Nasdaq, up by 0.1. I want to turn to the airlines. This was big news earlier this morning. Spirit and American both cutting their forecasts, citing a rise in jet fuel costs. Spirit also citing heightened promotional activity and steep discounting. Those stocks getting hammered over the last few months. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, higher fuel costs going to cause both Spirit and American to adjust either their revenue or their earnings per share forecast. Spirit slashing its revenue forecast for the third quarter. It was looking for $1.3 to $1.32 billion. Now it's looking for $1.245 to $1.255 billion. This on a jet fuel cost estimated to be at $3.06 per gallon. That's about 26% higher. 26 cents higher than it had previously anticipated, talking as well about that lack of demand, that steep discounting that it's been doing, especially seen it in the past 3 weeks, going to extend, it says, through the pre-Thanksgiving period. American also seeing now $2.90 to $3 per gallon jet fuel costs in the third quarter, that forcing it to cut its adjusted earnings per share from 85 to 90 cents or 95 cents to now 20 to 30 cents. Also saying it's got to account for some of those payments, roughly $230 million to airline pilots under its new contracts. We saw some of the reflection of that the falling airline fare costs in the CPI data this morning. Airline fares down 13.3% from last August, and this really taking a hit on all of the airlines in trading today.
And so we're told. We're just not feeling it quite yet, Simone, but I trust the data. Hopefully fares are coming down because we all want them lower, don't we? Simone, thank you. This market picked up the scent of this story over the last couple of months. Airline stocks on the S&P 500 down by more than 22% from the highs of July. More than 22%, that move lower off the back of these negotiations with the labor story. Airlines, American Airlines, I'm thinking of them. Higher jet fuel prices off the back of this move in crude in the commodity market. I'll give you the update at the moment. WTI just short of 89, Brent crude through 92. Let's finish on the banking sector. Citi preparing for a wave of job cuts as it restructures to operate from 5 main businesses. The Wall Street giant saying this: as Citi swiftly transitions to this new model, the firm is committed to retaining top talent and supporting employees who are leaving the company. Shanali has more. Hey, Shanali.
You have Jane Fraser, the CEO of Citigroup here, John, just taking an axe to Citigroup's management structure, now having 5 business heads with all of the groups rolling up to those 5 in particular. Now, who does that include? It includes the unequivocal trading and markets head, Andrew Morton, as part of that team. And very surprisingly here, you have Peter Babet, the head of Asia Pacific, now becoming the interim banking head, leaving open a position at Citigroup and putting them on a search for a new division of one of the top 5 M&A, IPO, and debt underwriting advisors across all of Wall Street. Now, this could be pretty painful for a lot of managers across different divisions over the next couple of months as they figure out just what other layers beyond this top 2 start to go away. Initial reaction from the market is they like it. This may result to a very streamlined bank after Citigroup has already exited certain markets. They don't have yet financial results across these new business lines or a target of what that full workforce reduction would look like or the severance costs associated with those reductions. But at the end of the day, a year from now, you might have a much more streamlined Citigroup.
Brilliant reporting, Shanali, through this morning. Looking forward to more from our chief Wall Street correspondent on the latest on Wall Street with Citi. Want to get to Morgan Stanley's Caterina Simonetti, expecting late cycle sectors to outperform, and adding this: pay attention to fundamentals, stick to quality, and have a longer term investment view. Stay disciplined and recognize the pullbacks in the market as potential buying opportunities. Caterina, I'm pleased to say, joins us now. Caterina, let's start with this phrase, late cycle. I've said over the last few months, it feels like the economist who cried recession. Through the whole of this year, I was told late cycle. Why are we well and truly in late cycle?
Well, John, thank you for having me on the show. And one of the things that we're seeing right now is this very conflicting data. And let's take a look at the inflation numbers this morning, right? You know, on one side, we see inflation coming down, but we also see parts of it that are still up, which is very concerning to consumers, like energy, real estate prices, rents, the services, travel. And this is very typical of the late cycle where we see this conflicting data. Unemployment a few weeks ago, actually is coming down. At the same time, we see enormous pressures on earnings and profit margins, and we're expecting, that to be translated into, some of the dips before the end of the year. So therefore, in our view, we think that we are in this late cycle, which means that, on the flip side of it, eventually things are going to start getting better, but we're not quite there yet.
Katerina, let's build on that and stick to energy just for a moment. Brent at 92, WTI just short of 89, 88, 90 something this morning. Energy stocks on the S&P so far this month before today up by more than 4%. Is that a move I want to stick with or a move I want to fade?
Well, Jonathan, so far this year, the stocks that performed were this Magnificent Seven, right? The area that already was the leading sector in the last bull market. And yet, we were kind of all on the bandwagon that was going to be the sectors to stick in. And what we think that investors should stay with quality. They should be invested, fully invested through this market cycle, but at the same time, they need to stay defensive. And one of the top areas in this defensive play would be energy, because a lot of energy stocks pay good dividends. We use a lot of energy. We all drive our big cars, especially here in the United States. So the energy use is there. And we think that energy definitely plays a very significant role in the portfolio, along with financials, healthcare, industrials, materials. All of these are sectors that we would like to see in portfolios because we like the positioning, we like valuations, and we also like the fact that these sectors are paying very good dividend yields, which is important.
They're the price makers as well in energy. So let's talk about the price takers, the airlines. The airlines at the moment have to absorb those higher energy prices that we've been talking about. And what we've seen this morning, what we've witnessed, are basically downgrades cuts to the outlook at Spirit, at American Airlines. Katerina, I know you can't do single names, but for the sector, for the airlines, what area of discretionary spending do I want to be in right now? What do I want to avoid?
Well, I want to answer your question with focusing on consumers. And consumer has been under tremendous amount of pressure. The inflation is real, and, seeing the prices go up, eventually kind of curbed that enthusiasm that we saw, coming out of COVID, where, we were so deprived of travel and we wanted those experiences, and we see the prices of air travel going up. But how much longer can it last? Specifically, as we're facing the reality that interest rates might be higher for quite some time, and that we see the companies cutting costs, we see layoffs, and all of that really puts pressures on consumer confidence, where, they might be a little bit more reluctant to spend money, on this excessive cost of travel, and we see the incentives, we see prices of the airline tickets coming down, but not enough to really incentivize people to continue to travel quite at the same rates as they have been, so this is the sector that we are telling our clients that they should probably avoid for a while and stick with more defensive plays.
Bank of America this morning, tight labor market, solid balance sheets, lower income resilience, and goods deflation leave us constructive on the consumer. Katerina, your story, do you expect it to show up in the retail sales number we get tomorrow morning?
The retail sector is a little tricky because, again, when we look at the inflation and when we look at the data that is coming out, that's the first area where if you're going to save some money, what are you going to continue spending on consumer staples, on energy, on healthcare, on things that we absolutely cannot go without, but we see the weakening in retail, and it will be interesting to see what the numbers are going to tell, if they're going to support the story, but most likely we're going to see some weaker numbers.
We'll see. Katerina, thank you. Katerina Simonetti there, the latest from Morgan Stanley, looking ahead to that retail sales print that we get tomorrow morning. Coming up on this program, the IEA's crude warning.
With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk tightening the market, increasing volatility.
Team coverage up next with crude prices at 2023 highs.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another. One of the only sports in the world in which you can
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture. We set out to find what's happening and what's about to happen.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news.
I'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Straight to some breaking news. I'll have a full roundup.
We have so many important conversations. Let's check in what you need to know.
Market is really tightening in the second half of the year. Already in August, we saw global oil inventories falling by a massive 75 million barrels, according to preliminary data. And with the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk, tightening the market, increasing volatility.
The IEA warning that Saudi and Russian production cuts will create a significant supply shortfall, writing this: oil stocks will be at uncomfortably low levels, increasing the risk of another surge in volatility that would be in the interest of neither producers nor consumers, given the fragile economic environment. The announcement coming as Brent hovers at 10-month highs above $92 a barrel. Your team coverage starts right now with Bloomberg's Anne-Marie alongside James Herod. James, can you talk to me about how big that supply deficit is going to be later this year?
Yeah, well, the market's already tight, and it's looking like it's going to remain at least just as tight. You heard the number from the IEA there of 1.4 million barrels a day in the fourth quarter. Interestingly, the numbers from OPEC actually are almost twice as large for the supply deficit, largely because OPEC has a much more bullish view of demand. So really, the difference may come down to how the economy's doing, and very particularly how China's doing.
James, do we have a decent idea of how that demand picture looks like, what it looks like in China currently?
Well, you know, there's been a lot of talk about China's weakness, but some analysts who've recently been reporting on China, some who've even traveled there, are saying that oil demand is stronger than you would think, given the weak state of the economy, and there may even be a decoupling between the strength of oil demand and the broader economy there. So perhaps the more bullish estimates of Chinese demand will turn out to be correct.
Anne-Marie, the President would like a good story to tell about inflation. Does this crude market complicate that?
Oh, it certainly does, Jonathan. And the cherry on top of the cake for that has to be today's inflation report, with gasoline being the single biggest contributor in overall prices moving up in August. And when it comes to the psyche of the American consumer, there was a survey done last year. Remember when gasoline prices over the summer were about $5 a gallon? The issue is that when consumers see higher pump prices, which are on every side of the road, it starts to affect how they are going to use their paycheck to paycheck. How are they going to decide what they're going to buy? And it starts to impact actually some of the feelings they have about their pricing power, their purchasing power in the United States of America. The president, the latest polls show he continues to get poor report card when it comes to his handling of the economy. Quinnipiac says it's only a 36% approval rating on the economy. And the biggest issue for him is inflation and gas prices. That is going to be a very difficult one for them to really try to sell Bidenomics on if the pump prices are going up.
James, final word. This is happening with crude output in America near record highs. It's happening with the SPR drained after the events of the last 18 months or so. James, just how vulnerable is the US to a price shock with all of that in mind?
Yeah, as you say, there really aren't a lot of levers that the Biden administration can pull, especially when the relationship with Saudi Arabia doesn't seem to be on particularly good footing. As we know, last year the White House was pressuring the Saudis to open the taps, and they did the exact opposite, and there's no sign of any shift in that relationship right now.
WTI 88.50, Brent crude just short of 92 now, breaking down a touch, 91.90. AMH, James, thank you for the latest in the crude market. Let's get the latest in the equity market, some sector price action. Here's Abby.
And the sectors this morning are pretty evenly distributed to the extent that they can be, given that there's 11. But the reason I say this is we just have a few, one more that is lower. Energy down about 0.6%, with oil's small decline, and then 5 higher, but consumer discretionary up just about the equal amount to the upside, being led by Amazon, Tesla, Ford, and others. As for those airlines, though, John, let's take a look at that decline you were talking about off of the July peak. It's really pretty brutal. So American Airlines today, not really completely not priced in, not new to investors, basically a bear market over this time period as investors do worry about these rising costs. And will airlines be able to manage them, and will there be demand from travelers?
Abigail, I'm with you. This market's been there already. It picked up the scent of this news that we got this morning. We're down over the last month by something like 8%. And based on that chart that Abby just put out, from the highs of July, we're down more than 20% from the highs of July for that industry group. About 23 minutes into the session, we are positive here by 0.1% on the S&P, on the Nasdaq up by 0.1% also. Inflation data, the tiniest, the smallest of upside surprises on core CPI. Drove yields a little bit higher initially, then that move faded pretty quickly. Yields on the 2-year lower by 2 basis points, just above 5% at the moment on the 2-year. On the 10-year down about a single basis point, still in and around 430 at 427. Up next on this program, your trading diary.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the chief future officers of some of the world's most influential companies.
25 minutes into the session, you know what we say, no drama here really on the S&P 500, up by 0.1%. Similar move on the Nasdaq, some slight underperformance again on the Russell, the small caps pulling back by about 0.4%. That's the price action. Let's get to the calendar. This is how things are shaping up in the trading diary. Thursday, tomorrow, initial jobless claims, US retail sales and an ECB rate decision, plus the UAW strike deadline at midnight. Friday, some economic data out of China, including property prices and industrial production numbers. Sneak peek of next week, next Tuesday, President Biden in New York for the UN General Assembly. And on Wednesday, the main event for us on Wall Street, a Fed rate decision and Chairman Powell news conference. All of that around the corner still to come this week and beyond into next week as well. From New York, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports. To the cornhole boards at your local tailgate.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning.
and good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We got some green on the screen today. Inflation data came in generally in line with expectations. Coming up, big restructuring at Citibank. We'll break it down.